You know that feeling, right? You look at your investment portfolio after a tough week in the market and just think, well, there's a loss. But what if I told you there's a way to find a silver lining in that loss, especially when it comes to your tax bill? Well, that's exactly what we're going to unpack today as we dive deep into the new rules for capital losses under the Income Tax Act 2025. It's a situation every single investor has faced, but seeing red in your portfolio doesn't have to be a complete financial hit. You see, the Income Tax Act 2025, specifically Section 111, gives you a powerful tool to soften that blow. It lets you offset those losses against your gains. But how does that actually work in practice? Let's find out. So here's the big question for every tax professional, CA student, and business owner tuning in. With the brand new 2025 Act here, has everything we knew from the old 1961 law been thrown out the window? Are we dealing with a completely new game? Or is it more of a familiar playbook with a few new rules? Let's take a closer look. And you can breathe a sigh of relief. The great news is that the core principles have been carried over. This means that the fundamental logic you've been working with for years under Section 74 of the old Act, it translates directly to the new Section 111. The foundation is the same. There's no need to relearn everything from scratch, which is fantastic. Okay, now that we know we're on solid ground, let's get into the real mechanics of it all. How do you actually use a capital loss to your advantage for tax purposes? It's a pretty straightforward two-step process. First, you set the loss off, and then, if there's anything left, you carry it forward. Let's break that down. Just think of it like this. First, you try to balance things out within the current year. That's step one, the intra-head adjustment. You use the losses you made this year to cancel out the gains you made in the same year. Now, if your losses are bigger than your gains, you don't just lose that benefit. That's where step two comes in. You take that leftover, unabsorbed loss and carry it forward to use in future years. It's like a tax-saving credit you keep in your pocket. So let's zoom in on step one. This whole process of setting off losses against gains in the same year is governed by Section 108 of the 2005 Act. The principle is simple. What happens under the capital gains head stays under the capital gains head. It's its own little world. Before you can even think about other types of income, you have to sort out the gains and losses within this one category. But, and this is important, inside this world, there are some very specific rules you have to follow. Okay, now this slide right here, this is probably the most important slide in this entire explainer. Getting this wrong is a very common and very costly mistake. A short-term capital loss is super flexible. You can use it to set off against any capital gain, whether it's short-term or long-term. But look at the long-term capital loss. That word only is absolute. It is strictly ring-fenced. A long-term loss can only be used against a long-term capital gain. That's it. Understanding this distinction is absolutely key to proper tax planning. And just to hammer that point home, Section 109, subsection 2, builds a firewall around this entire process. The bottom line is, your capital losses live in their own world. You absolutely cannot, under any circumstances, use a loss from the stock market to reduce your taxable salary or your income from business. The two just don't mix. So, what happens to the loss you carry forward? Well, think of this number, 8, as a ticking clock. Under Section 111, you have 8 assessment years after the year of the loss to find a suitable capital gain to set it off against. It's a classic use it or lose it situation. Once those 8 years are up, that loss is gone. It disappears for good. All right, that's enough theory for now. Let's be honest, these rules really only make sense when you see them in action with some actual numbers. So let's walk through a practical scenario to make it all crystal clear. Okay, so here's our situation for the tax year 2026-27. We have a short-term gain of 3 lakh, a long-term gain of 5 lakh, and a long-term loss of 4 lakh. The challenge is to use our knowledge of the rules to figure out the correct taxable income. Let's solve this puzzle together. And here is the solution. Remember that golden rule we just talked about? A long-term capital loss can only be used against a long-term capital gain. So, that 4 lakh LTCL must be set off against the 5 lakh LTCG. That leaves us with a taxable long-term gain of just 1 lakh. The 3 lakh short-term gain remains fully taxable because the long-term loss can't touch it. Simple as that. Okay, so you get the what. Now let's talk about the how. Knowing the rules is one thing, but actually executing this correctly and staying compliant, that's the real challenge. So let's talk about some of the most common pitfalls, especially as we navigate this transition from the old act to the new one. Now, this is the one rule that is absolutely non-negotiable. The right to carry forward a loss isn't automatic. You have to earn it. And you earn it by doing one simple thing: filing your income tax return by the due date. Section 121 of the new act makes this crystal clear. If you're late by even 1 day, that loss is gone, forfeited, permanently. There are no second chances. This brings up a really important question that I'm sure is on many of your minds. What happens to the losses you've already been carrying forward from previous years under the old 1961 Act? Are they still valid? Can you still use them? It's a critical point, so let's clear it up. This flowchart, which comes straight from the official guidance, lays it out perfectly. The eligibility of a loss from before the transition is judged by the rules of the old 1961 Act. So if you did everything right back then, meaning you filed your loss return on time, then you're in the clear. That loss is valid and you can carry it forward under the new 2025 Act. But if you didn't, well, the new Act can't help you. And this quote from the official FAQs drives the point home. The new Act is not a get-out-of-jail-free card. It won't fix past compliance failures. Section 536 acts as a bridge to carry forward valid claims. It is not a time machine to go back and fix old mistakes. If a loss was ineligible before, it remains ineligible now. Whew! All right, we have covered a lot of ground, from the basic principles to the nitty-gritty calculations and compliance traps. So let's just take a moment and boil it all down to the absolute essentials, the key takeaways you need to have in your back pocket. So here you go. First, the good news. The core mechanics haven't changed. Second, always remember the huge difference between how a short-term and a long-term loss can be used. Third, keep that 8-year countdown clock in mind for any losses you carry forward. And finally, the most important rule of all, file your return on time. If you can master these points, you're well on your way to handling capital losses like a pro. And that's a wrap. I really hope you found this explainer useful. If you did, it would mean a lot if you could hit that like button, subscribe to the channel, and maybe share this with a colleague or friend who might also find it helpful. Your support is what allows us to keep making these. And just a quick final reminder, this is for educational purposes only and is not professional advice. Tax laws change and everyone's situation is unique, so please, before you take any action, make sure you consult with your professional tax advisor. Thank you.